Good morning, everybody. It's Patrick Merrill selling the beautiful Gulf Coast from Mississippi all the way down to Florida. I'm licensed in 3 states. I have started a little podcast I've been working on. I'm trying to get some opinions from all over the world and different lifestyles, the way people live, and what they look for when they're coming out to Mississippi or Alabama or Florida looking for the new property. We got Landon here. He is going to go over a couple things with some lending options that we not a lot of people even realize was out there. We're trying to help buyers get into homes, and there's a lot of education that we can help buyers. 'Cause a lot of times the buyers landed don't even know where to start. What would be the best advice for you?
Thanks, Patrick. I appreciate you letting me be on the podcast today.
Definitely.
So, again, I'm Landon McCarty. I'm with Fairway Home Mortgage. I'm located in Ocean Springs. Fairway is a lender in just about every state. I'm licensed in Mississippi. Just to clarify that, but we have other team members in our particular branch or office that are licensed in Alabama, Louisiana, Florida, other parts of the nation.
Well, that's a lot of people don't realize we can help them no matter usually where they're going. And try to connect them with even just word of mouth. There's a lot of people, and I know a lot of agents take these other courses, for like military relocation and different credits you can have under your name, so to say, which helps a specific type person move into an area. So I like military. We get a lot of military here because they may only be here 3 or 4 years, and when they'd rather sell a house, buy new, and sell new for their return in the long run. But definitely,
you mentioned that. I get so many military members that come back to our area.
yeah,
They realize that they enjoyed it so much in their time here. And then, of course, our cost of living is just phenomenal down here. It's so low compared to other places that their dollar just goes further here than it does elsewhere in the nation.
that's what I like about it. Is coastal is a different way of living. We're a little bit more laid back. You don't have that crazy, people that come from either Atlanta or those big cities with all that crazy traffic. They're like, yeah, I don't get in a hurry, do you? I'm like, welcome to the coast. You'll love the South.
That's right. That's right.
We get in a hurry at times. So if I'm having issues with my credit, say I'm about 620, and can I come to you and you can correct whatever and look at things and help me fix it within a certain amount of time? Or because just out of curiosity.
Absolutely. Yes, we can definitely do that. So, I mean, that's kind of a part of the process that we go through with all of our, all of my customers is it's never a dead end road. You just may not be there yet.
Right.
So, at that point, we kind of kick things over to, well, let's look at that credit report. Let's look where you are financially and let's analyze that and let's talk about what steps we can take to improve upon where you are right now. And that's a pretty thorough conversation because that individual's budget, they know that best. And so we can give them suggestions. I can give them recommendations of, maybe setting up a secured credit card out there to help spark some of the maybe revolving debt that they don't have on their credit report to kind of help pick their score up or make other suggestions. Because really, when you're looking at a credit report, the bureaus kind of look at it as kind of like a piece of pie or a gumbo,
Okay.
They want to have these little different mixes, they want to have some basil leaves in there. They want to have, some certain spices in there. And so if we can help create that gumbo for them to get their score up, it really can spark something in either maybe a 3-month period of time, a 6-month period of time.
We're going to heat it up with some cayenne pepper.
So,
What
yes.
about, let's say Becky and Tim come to me, and Becky's got great, great, great credit, but her husband has horrible, horrible credit, but her husband's got good income. Becky's got good income as well. So could you use the husband's income and not so much of his showing his scores with something like that? Or how would you advise them to handle it?
That's a great question. Because through that process, we are required to use the lowest credit score. Take that back. Not the lowest credit score, but really the lower of the middle of the individual's credit score. Let's put it this way. So Becky's got a 750, but her spouse has a 620.
We try to keep him out of the casino. Tim just keeps going back over there.
So unfortunately, we'd be required, if they're both going to be on there and we need that for his income, to utilize his income, we would be using that 620 score to basically work through that file. At that time, depending on how impressed they are to go out and purchase a piece of property, we can actually look at that credit file and use our tools that we have to analyze, say, if we made these certain changes, we can boost his score up by 50 points or by 80 points.
And that's from 620 to 680. Is that right? Yeah, 60.
Yeah.
That's a big jump.
Yep. And then also try and give them a time period of, how long that would take as well. So then it really becomes a customer's decision. Having that ability or that choice is power. And so it's up to them. Do they want to go through that process, do that, or are they satisfied with where they are now with looking towards maybe making those corrections, in the future, and then coming back to us maybe for a possible refinance later on?
Is that a thing? Are lenders still offering a one-time refinance or anything like that? I know the rates have come down a little bit, but I want to say some y'all had been offering, if the rate goes down, a one-time closing or a one-time refinance.
So yes, we do. I mean, the individual can pretty much almost refinance at any time, period. But yes, that option is always out there. There may be some incentives out there to kind of help them out, as far as, bringing money to the table. Most of the time they don't have to, because they're able to kind of finance that in to the closing costs and things like that. So that's definitely.
I try to do that a lot. We try to roll that in to help the buyers. Cause it's hard to find a house in a single person, no kids, or even a single person with a kid or two, or even a young family starting out. It's hard to get a note that's comfortable. Because a lot of times my buyers will get a pre-approved for $300,000. Good, okay, but we ain't got to spend it. Let's come up with a note that where you're going to be comfortable monthly. That's the biggest thing. And keep in mind, life happens. You break a leg, you can't work for a month. So you want to make sure you're not putting yourself in that tight of a bind that you can't dig out of that hole, because that 30 years is going to be 30 years. You pay it off quicker, when you're in a better situation. But going into all of it, that just seems to be a subtraction.
Yeah. Patrick, that's the most important part of that loan officer's discussion with that applicant, is to have a honest conversation with them. Because on paper, you're right. They could be approved for, 300,000, but, we don't see what that discretionary income goes to. We don't know the other expenses that they have outside of what's shown on a credit report. And so that individual knows where their money is going, but we don't always see that part. And so when I'm talking to an applicant, I'm asking them, this is what your total housing expense could be. Because we don't know what exactly the insurance is going to look like, their casualty insurance, homeowner's insurance. We don't know if there's going to be flood on it or not, because they haven't picked out a property yet, or they haven't gone under contract. And we don't know what those taxes are going to be. So those escrowed payments on their monthly housing expense, we don't exactly know those, but we can kind of estimate at it depending on what home price that they're shooting for. And take that to them and say, realistically, is that something that works for you in your budget? Do you see yourself being comfortable paying that for an extended period of time? Let them kind of soak that in.
Oh yeah.
Initial reaction is go, go, go.
Right.
I don't want to lose this property, but once the deal is done,
they're paying it. Exactly. And I don't want to see people get upside down, and unfortunately, the way the market is, the way the world is, we don't know what's going to happen from day to day, so that's why I put that out there. And like I tell people, it's like, you never know. You never know what could happen to you next month or 3 years down the road, and you're like, oh my God, thank God I didn't buy that house where my note was 2,000 a month. I got my note at 1,200, so I get to keep my boat, I get to keep my camper, and I get to go places on the weekends. I'm not having to pick up work.
You try to pick up on those life events that are coming down the road. Are y'all going to be, if it's a young couple, first time home buyer, are y'all looking to have maybe start a
Mhm.
family, grow your family?
And a lot of people do that. They use their first property as a rental.
Oh, absolutely. That's
Yeah.
definitely, that's going back to, house hacking 101.
Yes.
But, if it's another couple, they may have a child going off to college.
That's true, because we get people downsizing. And a lot of people, these old Navy houses have been in Pascagoula forever. I mean, forever. I mean, they started building them to help with the shipyard. There's nowhere to live, when the shipyard was taken off. So they built all those Navy houses. And those people are buying them up and turning them into cute little beach cottages.
I had one.
See, I love those little houses. They've been through they've been through every storm. They're still standing. Most of them.
Mine made it through Katrina like a champ.
Right? It's crazy.
They're great houses. So, but yes, and so that is kind of that overall. That's almost more important than the application itself when you're starting that initial conversation, especially with first time home buyers, because they don't anticipate or they don't see what's going to happen after this.
Exactly. I mean, things happen. Like we said, life happens. You get divorced, your kids are moving out, you want to downsize, or. So a lot of things happen, and hopefully always like good things to happen. But the biggest thing is going to keep Becky and Tim and amount that they can afford and live and enjoy their life. What would be the minimum score?
Minimum score, when you think about that, there are particular overlays depending on each particular financing type. When I'm talking about that, I'm kind of mainly talking about your agency types, conventional, FHA, USDA, VA. And so for us, that might be around a 580 or so. But really, there's other things that offset that all the time, especially when we're working that up with the underwriter, is somebody that has a score at this amount and another individual that has the same score. Somebody that's putting 20% down is putting a lot more equity position down into it. But that's a different risk assessment than somebody who's putting the minimum, say it's a conventional, and they're just putting, first time home buyer, they're putting just 3% down. So when we run that through and look at that, obviously, any investor or anybody else that's looking at that is going to feel a lot better with somebody that's put 20% down, because obviously they got a lot more sweat in the game. Their DTI might be a lot lower. There's a lot of, we call them basically compensating factors that help offset risk involved with extending somebody credit.
Now, what is the range for usually the debt to ratio?
That would be, so that does kind of change again, depending on, agency type. When you're talking about conventional, I think kind of like the gold standard is kind of 43%. But, on FHA, you can go all the way up to 50% DTI. What does that mean? What does 50% debt to income mean? You're basically saying out of every dollar you make, 50% or 50 cents out of that dollar is going to be going towards the repayment of your housing expense. So your principal, interest, taxes, and insurance. So sounds like a lot, but FHA will, at times they'll let you go up to that.
I mean, and it helps. It does help people get in houses. That's a lot of it. And buying a house, a lot of people don't I mean, I can tell when you close, you're gonna be at Lowe's. When I bought my house, I didn't have a rake, I didn't have a shovel, I didn't have none of that kind of stuff. A garbage can to take to the road, and garbage cans ain't cheap. Seriously, I mean, because it's so many things you don't realize you don't have when you buy a house from an apartment. Like you have nothing for yard tools. You don't have a water hose or anything like that. Then you gotta go buy a garbage can for your house inside, and it's like you need a lot of stuff. No, it's really not. It's not. It goes away after Katrina. It's like they gave us too many options, light fixtures and faucets. I mean, I had never had any idea. I I never paid attention to that aisle at Lowe's. And when I'm standing there in front of it, that aisle's full of kitchen sink handles. And it's like, I was just lost. I stood on the aisle, just looked like Wow. And I'm telling you, the price range went from like $29 up to 300 and something dollars. And I'm like, oh, that must be a good brand. Now I want the cheapest one, you know. Oh my gosh. I do. I like going to Lowe's. You know, like I said, almost every time, you know, you can always find a good deal at Lowe's. And a lot of times I'll tell people, like, look, don't go buy any big ticket items till after you've closed. Go to Lowe's, get one of their credit cards, get that. Usually it's 20% off their first big purchase and sometimes 9 months with no interest. Take advantage of it and get that 20% off. And if you can, definitely pay it off within that 9 month, no interest free. But after you close on your home, you got to let us do that, not prior to that.
Big gotcha that happens. Unfortunately, if you don't let your borrower know, or you let your client know in your position is like, these are the things you don't need to be doing. Don't
Correct.
go out and get new credit. Don't move money around. Set up another checking account and change things up as far as where your deposits are going. Don't change jobs unless it's for the better, or unless you consult with your loan officer about that. So yes, there are some things in the past that some people have experienced where they don't consult with their loan officers and they make a big change and then they realize that's something that they shouldn't have done.
No, no, totally. Totally. That's what I tell my mom. Don't change nothing. Well, I want to pay this off. Don't change nothing. Let it say. No, sometimes I've heard different lenders say they like to see that monthly revolving note, you know, and there's still a lot of people out there that pay strictly cash that don't have any kind of thing like that. And a lot of people, you know, that catches cash. My mattress didn't come like that, but some people that's got those mattresses and they still pay for cash with everything.
I'm working with an individual right now, and we're in that process of building his credit up. And so he has made great strides on it. But he called me up and he said, Landon, he said, I've got an opportunity to refinance my car to a much lower note. And I think right now he was at like 12%.
Oh,
He had to get this car when he was on tough times. His credit was already not so good. Uh, so he wanted to, he was asking me, like I asked him to do, said, is this going to be okay if I do this? I told him, I said, well, it's going to, obviously where we're going, it's going to be a short blip on your credit when you make that change happen. If you refinance it, there's going to be a short little blip. It might ding you a little bit, but that's going to go away after a couple of months or after a month. I do think this is a good thing for you to do. For one thing, it's going to set you up to be able to save more after you do this, because we talked about the numbers of the change and everything and how it was going to help them out. And I said, once you get that behind you, you're going to be able to save more going forward. And that's our next step. After we get your credit figured out, then that's when we start setting aside some money to where we can go towards, down payment and closing costs on the purchase of your home. And so he was helping himself out, and I firmly agreed with it.
smart. Very smart. And like you said, is able to take that extra and throw in the savings to get ready to buy his house. When I first time buyer comes up and they're like, okay, how much to get started would I be out of pocket? You know, like on our end, I was telling them, okay, you're gonna have appraisal fee, you're gonna have the home inspection, which everybody should do a home inspection. I don't even care if it's a new house or what. Do a home inspection. And then our taxes and insurance and well, we don't have to have that till we close, but that kind of say about 1,500 out to get going.
Yeah. So the biggest expense, so when you're talking to that, for one, you're going to know what your down payment's going to be based on what they're asking for. So that's going to be, we know what that's going to be.
So we're at 3 or 3 point. Is FHA's 3?
FHA's 3.5,
Okay.
and conventional, if you're a first-time home buyer, is 3%. And we've got some great first-time home buyer programs out there. But with that, the other part that they're going to have to bring to the table is their closing cost. And these days on the Gulf Coast, probably almost a third of that is going to be their first year's insurance premium. And so, when you factor in the attorney's work for the title work, settlement, their insurance, appraisal fee, if they have to pay for the WDI, would destroy an asset report, or home inspection, and then of course the fees as far as our work for doing the loan for them. You could almost be looking at anywhere from maybe $10,000 to $12,000. Again, because I'm kind of basing this off of a $250,000 purchase price. On that, you might be looking at insurance of anywhere from $3,000 to maybe $3,500. You are geographically buying on the Mississippi Gulf Coast. So hopefully, if you're eligible for some of those first-time homebuyer programs, that's going to offset generally maybe your down payment or your closing costs, one or the other, or a mixture of the two. Now, the important part here is where your loan officer starts talking to your realtor. And when y'all are setting up, when you found a property, you're looking to make an offer on that property, that's where you and I start talking. We say, okay, how are we going to structure this offer? Because right now we've got the borrower at needing this much cash going to closing. They're getting this much in incentives. What kind of seller concessions should we ask him for? Recently, a couple of days ago, I was helping out a first-time home buyer. He was eligible for $10,000 in down payment assistance.
Is that one you got to pay back, or is that one that has forgiveness?
It is. No, that one you pay back. Now it's that $10,000 is on a 15-year term, and it's at 2%. I don't know anybody out there that's loaning anybody $10,000,
No.
at 2%.
No, that's huge.
Yeah, it only adds $64.35 to their monthly housing payment. That's nominal.
Yeah, that's
So the benefit that's out there.
That's two people going to McDonald's. Oh my God! Now that's it really. It was almost down for one person. Just got to get anything. I guess almost $10, $15. I liked all those special meals. Yeah, Sonic is still doing the smash burgers for $6 with a drink and your French fries. So that was not bad. But oh my God, some of these prices.
So she and I talked. The realtor did, and
Okay.
so we knew what his end numbers were, and so she was looking at possibly lowering the offer amount and only asking for $3,000 in seller concessions. And I advised her, I said, look, let's restructure this. He's okay going full price, but let's get $5,000. And then that only had him bringing less than $1,000 to the table.
And that's huge. That's fantastic.
Win for him.
That's the best. To me, that's the way we like to do a lot of them. Because, you'll tell me, well, you can't tell me a lot of the individual's personal information, but because it's like, well, how are we looking on a down payment? Well, not good. Okay, so we know we need to be able to structure the loan into that. And most people are acceptable to doing that, because a lot of sellers, they want to sell a house. And I think as long as everybody's happy at the end of the transaction, that's the big thing, is getting there to where everybody's got the numbers, everybody's happy. But almost all sellers are okay with that as long as they're getting their numbers that they need. Because like I said, it's easy to buy a house and empty your savings account, and that's one thing I try to tell people: hold onto your savings as long as you can. Don't touch it. If there's any grant programs or anything like that, if you qualify, get on.
Down payment assistance programs are not a crutch. They are there. They're a tool. And they're a great tool, and people don't need to look at them in a negative way.
Totally.
We're not talking about, SNAP benefits here.
Right.
I don't want to cheapen that for, those individuals that do need that, because there's a reason why those benefits are out there. But down payment assistance programs, especially for first-time homebuyers, should not be looked on as like, I'm using this as a crutch because, I am at a certain income level. They're there to spur our economy. They are there to help people, and they should be used because it's there.
Right.
There's no reason not to look into that, because let's say, like, you are that couple and you are going to be starting a family later on. You may need that $10,000 later on to pay the medical bills and everything else after you have that first child, or for daycare and everything else. It's expensive. And so why not save that if you can?
Oh my God, I'll pay 2% on money all day long
to help buy your house.
So they don't have to pull it all. Let's say they approve, they can get an extra $10,000, but we got seller to pay 5. So that, and like you said, they only had to bring 1,000, so they could just pull the 5,000 or whatever they needed. Okay. And that would have them coming out of pocket hardly nothing.
Yeah, and they get to hold on to those other monies that they've saved up through this process. So it's kind of a, as a pleasant surprise for them, because they went into thinking, I've taken, 2 years, 3 years to save up all this money, and even though I'm about to make one of the biggest purchases of my life, how well would it benefit me if I was able to save on to some of that without having to use it for the purchase?
Oh, for sure. Yeah, and that's me. I'd rather try to keep money in the bank for sure. Do you see how are the interest rates running right now?
They're good. Our activity overseas has obviously kind of scared the bond market a little bit.
I have a buyer stuck over there for about 4 weeks now. They can't. Well, he's been to the airport 3 or 4 times. They'll get the airport reopened, and everybody will get there, and then it's like, boom, they have to shut it back down. They get a bomb threat or something looks wrong, so they have to shut the airport back down. So, but there are more people stuck. There's a lot of people over there stuck right now. It's scary.
The good thing is like all these first time home buyer programs, the rates really haven't changed at all. They're still at very good rates, very low. I think on that one, it was a FHA through Mississippi Home Corp. Again, it was that $10,000. On that primary mortgage, yeah, it was a 5.79. So all of those have not changed. They have not repriced those. So I think we're looking up for for non first time home buyers. I think we're looking for some good news to come out, as far as how this is all going to wind up overseas. And then we should start to see continued progression of rates coming down.
Good. Yeah. And that's why a lot of people, like I said, a lot of buyers ask me about the one time refinance, if that's a thing. And I'm like, no, I think it's still a thing.
It's still a thing. And I'll tell you one of the most powerful things right now for those individuals that bought a house 5-10 years ago is don't look at getting a 30-year mortgage. Refinancing a 30-year mortgage, look at doing 15. The rate's better, but the rates are going to be better. Now, it still might be close to where you are right now as far as rates, but what the more powerful thing is how much you're going to save, because you're reducing the timeline on that. So you may technically be going from, you originally went at a 30-year, you've paid it down to a 20-year term, and you're going to reduce another 5 off of it and almost keep your same payment where you are right now or a little bit less. You're going to save so much money. Well, I can do that calculation for you. And when the people see it on paper, it's a no-brainer.
Oh, yeah. I mean, when a little extra every month on principal ends up a great thing, I think. And a lot of people, I've always heard if you can pay an extra note to principal every year, it's just an extra way of doing it. And that's usually what I tell people. Easy numbers. If you have a $1,200 a month note, to pay that extra, just pay $1,300 every month. And let that be in your head. That's my payment with 100 going to this, and just keep it that way. So through the year, you're paying that extra note with the $100.
Oh yeah. Patrick, real quick. So one thing I did want to kind of also go into is kind of a subset or another financial option that I don't think most individuals aren't aware of. And those individuals being specifically self-employed individuals. I was kind of looking at some data this morning. And so as far as, self-employed individuals in Mississippi, it's usually about, I think, 1 out of every 11 people is self-employed in Mississippi.
Wow. That's pretty huge.
Nationally, it's 1 out of 10. So you think about when you go somewhere, you see, a group of people, you can kind of pretty much figure out, okay, at least, 2 of those people are self-employed. A self-employed individual has a financing option that they may not be aware of. And it goes to the name of these financing options are categorized as non-qualified mortgage loans. And so just to elaborate on that, where that kind of comes from is most of your agency or all of your agency loans, your conventional FHA, USDA, and VA are all considered qualified mortgages. And that goes back to after our financial crisis, back in the 2000s. It was Frank Dodd and all that came out, Frank Dodd Act, them firming up, and they created the Consumer Financial Protection Bureau, the CFPB. They came out with guidelines basically to basically solidify how lending institutions had to vet a borrower. And a lot of it regarded the ability to repay. Because obviously,
Okay.
the financial crisis, that was a big thing. We were doing, certain lenders out there were doing stated income. We really weren't, they weren't validating exactly where this money was going to come from on the repayment of this note. So that's where we got to now with the CFPB and Congress and everybody else put the earnest on lending institutions showing proof of how that borrower is going to repay that mortgage. And from my banking days, I spent about 10 years in banking. From my banking days, when an individual came in, if they were self-employed, they're not getting a W-2. So they come in, and most of the self-employed individuals are, sole proprietorships. So when they bring in their tax return, those are the kind of the documents that we use to validate what their income is, because they're not getting a pay stub. They're getting their distributions from their own business. And so we get that tax return, and we go to that Schedule C, and we look on there, and that Schedule C is going to have like their gross income, it's going to have all their deductions, and then it's going to have net income. So we'd go in there and we'd look at what the net income is. And then we might add back amortization, depreciation, interest expense, and then we come up with what that total number is what we would use, divide that by 12, and that's what we'd say what their monthly income is. And so that might be, it can end up being a lot lower than what their actual income is, because there's tax advantages to being a self-employed individual, because you can write off a lot of things that you do in your business. It's basically a tax strategy that you do to kind of reduce your tax impact, because obviously we all don't like paying. We like to pay Uncle Sam as least amount as possible.
Oh, for sure.
And so that kind of led to, unfortunately, when that came out, it made it real tough for self-employed individuals to get financing for mortgages. And it wasn't a fault of theirs, it's kind of fault of the system. So then that kind of spurred these non-qualified mortgage investors to come out and have these programs to kind of help out these individuals. And so a subset of those loan types are bank statement loans, 1099 loans, asset depletion loans, and profit loss statements.
So if I start this business in 3 months, do I need to have like a year of my being on my own business or anything like that, a time frame?
So we like to see 2 years.
Okay.
That would be the most optimal. There are some programs that we have that might allow for 1 year, but I really think to be able to set them up for success on the front end, we really need 2 years. That's the best way of us having a comfortable picture of what their income is going to be. And so let's kind of reference, a bank statement loan. So that individual, we're not even going to look at their tax returns. What we're going to do is the process is still going to be, we're going to take an application, we're going to pull their credit, but instead of asking for their tax returns to validate what that income is, we're going to ask for anywhere from 12-month bank statements to 24 months of their bank statements. And depending on how they have those bank statements set up, some people have it just running through their personal bank account. Some of them have a business bank account, and then some of them have what we call kind of a merged. They just commingle the funds into both. But we get, where that income is coming in. We get bank statements to where that income is coming in from the business. And we'll get 24 months. And there is a calculation that they run, and they look at all those deposits that come in. Now, of course, we're not going to use refunds from places that might be deposits coming in or dividend checks or something. But the income coming in from the business, that's what they're going to use. And they're going to kind of total that up. And then we're going to use that as their income divided out for what they actually make. And so we're actually including in those things that they write off or expenses in their now what they will do is they'll attach onto a expense ratio to that. Kind of the default is that it's going to be a 50% expense ratio for any business, unless their CPA can provide them with a letter saying that, this individual's business runs at a 30% expense ratio.
Okay.
Just kind of summarize that. They may have $200,000 in gross revenue from their business, but they write off a lot of it. And then at the end, they only show net income of $35,000. Well, that ends up being about $3,000 or so, a month.
Mm-hmm.
Think about if you're just looking at that gross revenue of $200,000, you divide that by 12, and that's a lot of money.
Correct.
Of course,
That's true.
Take it back. You look at that $2,000, you assign a 50% expense ratio. $100,000, divide that by 12, and you're looking at a lot higher monthly income than you are at just looking at that net income of $35,000.
No, yeah, that makes sense. Totally. I got one more question, then I'm gonna let you go. I get long-winded. Some of our school systems here are some of the highest paid in Mississippi. So we get quite a few teachers that come here, and I know it can be done, but I've never really dug a whole lot into it, but I know it's done. That way I can say, all right, I just got out of school, I got my degree, and I have a contract with Pascagoula School System or Ocean Springs Schools or Vancleave. Can you use my contract without because I've been in school. I don't have a work history or anything like that. Can we use my contract as what's going to be taking place for the next year or so?
So yes, that can be done. We've actually done that with other employer types, as long as it is a contract. Now, one caveat to that is if there's a probation period in there, we may have to wait until after the probation period is expired.
What do you mean by that?
What's that?
What do you mean by that?
Well, like a kind of a, you start a job, but they say, we can, we're going to review you for the next 90 days of your work performance. Okay. And then after that review period, then, you're with us. The employer might be able to just release you for any cause that you might have to go through. Then, yeah, we may have to wait till that time period expires.
Okay, that makes sense. And that's not long. And I tell people all day long, take a contract, even if it's 3 or 4 months on closing. You got a contract, take it.
Because again, we want to see at least a 2-year history of work, unless you've been in school. Now, if you've been in school, then we're looking for tax transcripts to show what you were doing during that period of time. And so that's perfectly acceptable because, of course, you go to school, you get a diploma, then you're able to get a higher level of pay and a better job than you would. Well, I say you would. Some of these craft workers, they go out and don't bypass college and they're making boatloads of money.
Right? Exactly. Exactly. I tell you what. Well, Landon, I have enjoyed talking with you this morning, and we probably went a little over our 30 minutes. Why don't you give everybody your contact information one more time, and we'll start wrapping it up.
All right, sounds great. I'm Landon McCarty, Fairway Home Mortgage. You can reach me at 228-235-1370. I'm also online, Facebook, LinkedIn, so feel free to find me, reach out. I'm happy to do any type of consultation if you're just thinking about purchasing a home or financing a home. Happy to help you out.
And the best part, it don't cost you nothing. Just make a phone call or fill out everything online.
Yeah, I promise a good conversation.
Yeah, and I mean I'm lifted. Are you lifted? You feel lifted today? I do. I feel like I'm gonna go do something good today. I'm gonna go list a house in Ocean Springs. But I tell you what, I'm lifted. You're lifted. We're all lifted. This has been lifted. Did I tell y'all this was lifted? All right. So anyway, we're gonna bounce out here with some good energy. And thank you again, Landon, for everything. And y'all, thank y'all for watching. Please like and subscribe. Thanks, y'all. Thank y'all again for taking the time to come along my venture with me. I am Patrick Merrill, and I hope you have been lifted. If not, let me know. We'll figure out a way. There's always a way. Thank y'all again for watching. Please like, share, and subscribe, and tell your friends. Y'all have a great day.